Happy Friday, everybody. Sorry I missed last week. I was traveling. So I am dedicated to get this posted this week. This week I wanted to talk about uh, IRAs. I've talked about them before in the past, um, but I wanted to bring attention specifically to Roth IRAs. So if you've watched the owner wages and IRA contributions video, you'll know, and if you haven't watched it, I highly recommend that you do. But basically, a traditional IRA, SEP, simple, self-employed IRA, anything with a formal retirement account, 401k, is a tax scam that makes you pay taxes until the day you die. Um, the government pushes them because it means they make money off of you. I do not recommend them in any shape or form. A lot of times they result in you owing taxes till the day you die. It results in locking up your money so that you cannot access it in the event of an emergency without having to pay a 10% penalty in addition to income taxes. And if you're self-employed or work for your own corporation, it just results in you paying more in Medicare and Social Security tax than you're actually even going to save on your income taxes. So that's just a quick synopsis of a typical traditional IRA or 401k. Today, I want to talk specifically about Roth IRAs. So the difference between a traditional IRA and a Roth IRA is a traditional IRA, you put money in tax deferment today with the idea that you will pay taxes on it when you pull it out in retirement. A Roth IRA is the opposite. You contribute money to it today with after tax dollars, meaning you've already paid taxes on the money that you contribute, with the idea that it will grow tax free, and then you can take the money out tax free in retirement. So it's just the opposite of a traditional IRA. There are some restrictions on a Roth IRA. For example, normally you can only contribute $7,000 a year per person. And there is an income limit that you can, as a single person, you can only make about $150,000 a year. After that, you're not allowed to contribute that $7,000. If you're married, I believe it's somewhere around $300,000 and some change. So those are the limits on contributing to an IRA. If you are going to contribute to an IRA, if you feel like you absolutely must contribute to an IRA for retirement, a Roth IRA is definitely the better of the two because it at least helps save you having to pay taxes in retirement. There are a couple options if you are outside of the income threshold, or if you want to contribute more than $7,000 a year. There's a couple of options that you can do. They are all done through what is called a backdoor conversion or a backdoor rollover. So basically, the idea is that you contribute to a traditional IRA, then you roll it from a traditional IRA into the Roth. This allows you to contribute more than $7,000 a year. Now, the issues with that, if you contribute to a regular IRA, there are two ways to do that. If you do it the normal way, that means it has to be ran through your wages, which increases your Medicare and Social Security tax. It defers taxes and basically runs into all the same problems that I already stated with any traditional IRA. So don't do that. The other option is, and you need to talk to your financial advisor or whoever is managing your IRA to get the specifics on this, because some companies offer it, some companies don't, and they may or may not even report it correctly on the 1099 when they give it to you and you give it to us or your CPA. But you can do what is called a non-taxable contribution to your traditional IRA. So this is just basically like contributing to the IRA extra money. Doesn't have any tax benefit. Then you take those same funds that you just contributed, and then you do a backdoor rollover into your Roth IRA. The reason why you would want to do that is because if you roll traditional contributions from a traditional IRA into a Roth IRA, the year you do that contribution, that rollover, it's going to be subject to taxes, because when you pull money out of a traditional IRA, it is subject to income taxes. The only benefit you're getting because you're doing a rollover is that that money is not subject to the 10% early withdrawal penalty. So if you contribute money as a non-tax deferment to your traditional IRA, you can then do the backdoor rollover conversion into your Roth IRA. That won't result in income taxes due because you didn't pay, or you didn't have deferred income tax on the original contribution. So that's one way you can get around that. Then when the money is in the Roth IRA, it grows tax-free until you hit the age limit and you're required to start taking minimum distributions, RMDs. Now, the thing about the money that you've contributed to a Roth IRA, because you put it in there with after-tax dollars, you can pull that equity out later. However, there are some restrictions on that. You cannot pull out your equity for 5 years from the moment you contributed. If you put it in and then pull it out immediately, it will also be subject to that 10% penalty. So you have to wait at least 5 years before you can pull it out. Then it won't be subject to that 10% penalty. So at that point, then any capital gains that had created during that time will still remain in there and continue to create capital gains for you going forward. You cannot pull out the actual capital gains amount. You can only pull out your original contribution amount after it's sat there for 5 years. So if you're going to contribute to any IRA, talk to your financial advisor, and that's probably what you should do. Stay out of a traditional IRA. It's just going to result in more taxes, but you can do that non-tax deferment contribution to your traditional IRA, do the backdoor conversion into the Roth IRA. That will then save you taxes both when you put it in and when you pull it out. The other thing is again, I'm not a fan of any IRA, and it's because of what I just said. Even in a Roth IRA, your money gets locked up for 5 years and you cannot access it. So these funds are strictly for retirement. They are not for emergencies. Well, I personally prefer to have a rainy day fund or a savings account or a life savings or something in the event of an emergency. So I do not use an IRA for that, because you will get penalized if you are forced to pull money out of that. Example, the economy crashes, your business is going down, you're not making as much money, but you still need to make your mortgage payment. And if all the money you have available to you is sitting in an IRA, if you pull out money to make a mortgage payment, you're going to owe a 10% penalty on that, in addition to having to claim it as taxable income for income tax purposes. So you're going to pay quite a bit of that funds to the IRS just so that you can continue to pay your mortgage. Instead, nobody wants to tell you this, people forget about it, but you are better off to put your money in just a regular stock portfolio and leave it sitting there. Why? Because in long-term capital gains, we have a 0% tax bracket. It's inflation adjusted every year. So for a single person, it's about $44,000 for 2025. For a married filing joint, it's about $85,000, and it's going to continue to go up. So if you are contributing today to save for retirement and you just buy and hold a mutual fund or stocks, you can let that money sit there, grow, and then by the time you're retired and you're needing to pull out of that, you could take, at that point, will probably be above $100,000 for married filing joint. You could take over $100,000 in long-term capital gains every year and still pay 0% tax. Long-term capital gains count if you buy into any investment and hold it for more than 12 months. So if you have a specific stock you want to buy, great, buy it, hold it for 12 months. When you sell it, majority of that gain will probably be tax-free. If you want to diversify, buy mutual funds. When you invest into a single mutual fund, that is your investment. So when you sell that mutual fund, then you will owe capital gains on that. But all the buying and selling that happens inside the mutual fund is not your realized gain. So if you open a traditional stock portfolio, you buy into mutual funds or you buy regular stocks, you can sit and hold on to them for more than 12 months and then they qualify as long term. And as long as you don't create a long-term capital gain greater than the 0% tax bracket, you will never owe taxes on your long-term capital gains. So that is a better method. You can contribute to, or you can purchase mutual funds to diversify, sit there and get your capital gains. If you get dividends, you will owe some taxes on the dividends, but the actual capital gains still won't be taxed. Then you hold it for a year or more. If the economy crashes and something happens, you can still access those funds without getting the 10% penalty and without having to pay income taxes on it when you sell, as long as you don't have a very large sell. To calculate the capital gain, when you buy, that's your equity in the stock or mutual fund. Then anything above that is your capital gain. So if you invest $500,000 today, or 50,000, let's do $500,000 to create a large example. If it then only grows to $600,000, you could still sell 3/4 of that and not have to pay any capital gains tax, because your actual capital gain, if you're married, will still be under that $85,000 threshold. So this is a way that if you want to pay closer attention to your actual stock portfolios, you can manage them. You buy and hold long term, at least 12 months. Then if you have to sell because of an issue or something else is going on, you then can pull out the funds without getting penalized. If you never have to pull it out, great. That's also your retirement fund. By the time you retire, you're probably looking at, if you're single, you're probably going to be looking at $80,000 a year in 0% taxes on your long-term capital gains. If you're married, then you're probably going to be looking at over $100,000 to be able to sell and take out as long-term capital gains. That's above and beyond your original equity. So that means you could probably have quite a bit of cash coming to you each year tax-free. So that's something I would prefer to see people get into. Again, traditional IRAs, tax scam. You pay taxes till the day you die. If you want to be in a tradition or in some sort of formal retirement plan, the Roth IRA is the best way to do that. Best way to get into it is to do non-tax deferment contributions to your traditional IRA, then do a backdoor conversion into a Roth IRA. At that point, you can access those funds after 5 years. Capital gains grow tax-free until you're required to start taking the minimum distributions. No taxes due on a Roth IRA when you take out those minimum distributions. My preferred method, use a traditional stock portfolio, invest into mutual funds, hold it long term, and then just manage how much you're going to sell each year to make sure you don't go past that 0% tax bracket threshold. The next bracket is 15%, so it's still not a lot, but just keep that in mind. Okay, I hope this is beneficial for everybody. Have a wonderful weekend.